Awesome. So now we have another fundamental play. Is a little bit based on this heuristic of, this idea that a lot of people start out with is, investing in like companies that you know. So investing in sort of well-known or common companies, which makes a lot of sense. So, if you see a brand or you see something day in and day out, you're always, spending money at Apple or go to the store somewhere, you always go to Home Depot or wherever it is you go, you always see one company over and over and over and over again. Usually, like if somebody's in the market and they're doing whatever it is that they do, whatever like their niche is, and they're like doing it over and over and over and over and over and over and over again. Like if you've got somebody that's consistent, and that's a big thing here, if you have someone that's consistent, it doesn't necessarily mean that they're making a whole lot of money because of what? Because of margins, right? So you could have like the entire market, but if your market or your margins, like even if you have like tons and tons and tons of clients, it all comes down to margins. You can have companies that maybe tons of money top line, right? They're making like billions of dollars, but at the end of the day, maybe they're only making like $40,000. Now, if you have a company that's bringing in $1 billion, and at the end of the day, it only makes $40,000 in net profits, I mean, that's not a very scalable company. That's not a very quality investment. I would probably not want to run that, considering the headache it would take to run $1 billion company. Like that's a difficult thing to invest in, and so that's as we start to look at Wi-Fi, Boingo Wireless. One you might have heard, they do like all the Wi-Fi for like planes, and they're also really involved in the military, and they do just like a lot of general cellular data. They're pretty big. They're all over the place. The market cap is literally $640 million right now. So you can kind of tell like they're a pretty sizable company. They're a pretty common brand. I wouldn't say maybe something that everyone would know about, but I kind of figured out about them on flights and looking at just like who services Wi-Fi. And I mean, their ticker is Wi-Fi, so like it sounds like a tech company. It sounds like something that should do well because like everyone has to pay for Wi-Fi, right? So that was kind of my initial mentality coming into this company. And so what I did next was interesting. I read the annual report, and I'm not going to go up the real annual report, but I want to go over the financials tab just to kind of show you what their financials look like, because like it's pretty solid. If you look just at revenue, like they keep making more and more and more money. Like last 12 months, they made $267 million, and like their costs are going up, but so is like the revenue. And so like they've got a pretty solid curve, right? I mean, it's not anything difficult to comprehend. Like they make more and more and more and more money, and obviously this is like the past, we'll call this 4 years, right? And so as we come and we look at this stock price, I want you to kind of think about money versus actual stock price. Here we can kind of see the price for the past couple of years, and even though like their earnings have done nothing but go up, and they've been making hundreds of millions of dollars and doing a pretty freaking solid job at it in top line revenue. If you look sort of at the end of the day, here at this line right here of reported earnings per share, with either basic or diluted, they're basically about the same. You can see that they're actually losing money. These are negative, right? So if you have negative earnings, that means you're not making money. And so what that's going to show up with Yahoo Finance, which is going to be a big red flag. The summary tab, if you look at the PE, you're going to see that the PE ratio is NA. And the reason why is because you can't really divide a price by negative earnings and then get like a number that's positive. It just doesn't really work like that. And so they'll show it up as NA because they don't actually make any money. So even though they're bringing in millions and millions and millions, hundreds of millions of dollars, right? So multi-million, hundreds of millions. They're bringing in hundreds of millions of dollars. At the end of the day, they're not even making 40 grand. Like they're making negative money. And so that's not great. That's not a good thing. Now, when I was starting out, I didn't really understand this concept, and I saw only one thing. The one thing I saw was top line revenue increasing. The one thing I saw was that revenue was going up, even though in reality earnings were going down. So that's why it's important not to just take financial reports at face value, because obviously these companies, they want their stock to do well because the executives that sort of manage their stocks are going to have an incentive to make the stock go up. Like if you have, this big pool, this table of managers, people that work at the company, and they're all kind of scheming around their cool little Wi-Fi table, doing whatever it is that they want to do. Like at this, meeting with the board of directors, like they have one single objective, and their one objective revolves around little dollar signs floating around their head, and they have to make a decision: should we make money or should we not make money? For them, like they own usually very, like almost every single time, they own a big chunk of the company's stock. Now it's not like 10% usually, but like a percent of a $650 million company is like $6.5 million. And so even if they only own like 1% each, or if they own like maybe half of a percent, you know, maybe say this guy owns half a percent, like that's still $3 million. You know, this guy over here, he might own like 0.2%. That's still like millions of dollars. So these guys have a small interest compared to the overall market, but on an individual basis, you'll see a lot of these people on the board, right? The board of directors have a pretty big interest in one thing. And the one thing they care about more than almost anything else is the stock price, right? Because if the stock price goes up, even by like 10%, like to them, 10% of a couple $1 million is 6 figures, right? And so as they come together, they only want one thing to happen, and that's the stock to go up now, right? Because they can sell their shares. They have to go through a little bit of a registration process, but like they can sell their shares. It's not that big of a deal. And so because all they want is the price to go up so they can make their money, and because like when the stock goes up, they make money, it makes sense for them to kind of focus on predictive things like revenue instead of maybe some bad earnings, because their earnings weren't great. It's more important for them in the PR reports or in the earnings reports. You'll see every single quarter, you can get on a live conference call usually with most of the big companies, and on their live conference call, they'll have like the earnings report. You can actually call in and listen to the earnings report. It's actually a pretty fun thing to do. I've done it many a times with some of the bigger companies I've invested in, and it's cool because like you're like actually hands-on. You're like in the zone with the like executives in the company. You're in the zone actually talking to some of the leaders of the company that are reporting the financials on, you know, whatever day it is they're reporting. You can like actually call in and be like, hey, I remember I was in, I think, science class one day, and NVIDIA had their earnings report, and I was like, what? NVIDIA's reporting? I want to hear the earnings call. And you learn so much about the industry and about where they are, not just as a company, but as an entire sector by kind of calling in and just listening to what people say, because they're gonna say like, this is how much money we made, this is how much money we made per share, this is our earnings, our revenue, this is our growth in whatever sector. I actually learned a lot calling into Oxy Tectone, OXY is the ticker. It's this oil refining company, and you learned I learned like a bunch about the current state of the oil economy. All I had to do is pick up the phone and spend 20 minutes listening into their earnings call, which is totally public. There's usually a number to dial, and honestly, it's usually on Yahoo Finance. They'll just say like earnings conference, dial in, and then you dial in, or you can just Google like earnings conference, dial in. You can dial in whenever. It's usually like 4:30 or right after the market closes. Some of them are in the middle of the day, which is kind of weird, so it just kind of depends on the company. But anyway, you call in, they'll like tell you like everything you could ever want to know about like an industry and a sector, alongside their actual underlying financials, which is actually like a really cool way. If you want to kind of skip a lot of the work that comes in behind learning about the brands you're investing in, about learning about like the common stocks, really a pretty phenomenal strategy is to just call, like just listen to earnings calls. What's cool is if you accidentally miss the call or you can't make it live for whatever reason, very often within like a couple of hours, usually someone will post on Yahoo Finance under like the news, it'll come up on the news, someone will post an edited transcript, so you can listen to these transcripts that are actually explaining these earnings, and it'll actually tell you a whole lot about the overarching company at the same time, because you'll hear a lot about fundamentals, a lot about their growth plays, a lot about what they're actually doing actively to create higher and higher returns. So that's something, I never did it with Wi-Fi, and I probably should have, because I would have more than likely learned about a lot of things that would have helped me out as I was starting out. So let's actually go now and look at how this investment performed. Look at a couple of cool things you can take away from it. So what I want to do first is I want to kind of get rid of all these indicators because they aren't as important. Like I said, this was more of a fundamental play. I'll leave moving averages just because moving averages are like amazing. But I think, you know, if you guys have been through the Stock Market Secrets Masterclass, you kind of understand. And I think we already talked about this, right? This head and shoulder setup, right? It was actually kind of funny. The other day we were looking at Virgin Galactic Airlines, a freaking hilarious stock. They've been absolutely crazy. SPCE. And I remember I was looking at SPCE and they kind of have like an intraday head and shoulder setup. And somebody like cropped in a picture of Batman, and it was like Batman standing right here, and then the stock went like over his shoulder, over his head, and over his other shoulder. And it was like a Batman head. It was really funny. And so that's kind of one cool little way to remember. But basically you've got your shoulders you got your neckline, you got your head. And as you can see with this stock, I mean, that's basically exactly what happened. If we go in and we kind of draw these lines, you can kind of go over here, you can click horizontal line, and it makes it a lot easier to draw lines. You just bring your mouse over here, you can click, and it'll draw a line for you, so you can see kind of a neckline there. I would say probably the shoulder line, top shoulder, is usually you want to be more conservative when you can. Honestly, if I was looking at this in the past, I would have probably seen this, the head and shoulders right here. But then it freaking exploded out of it, which is insane. I probably would have lost money if I was actively trading that. Just a little bit. I would have probably gotten in right here, the short, and then I always had a stop loss at about 26, so maybe about $1, $1.50 down there. But then what's cool is if you have a bigger setup like this, all of a sudden you short the second shoulder at 25, and it goes down to freaking, well, let's see. So what you want to do is you take the height right here, right? You want to take whatever this height, whatever this difference is between the neckline and the height, you want to just kind of use some finger math, put it right down here, right? So you take that, it should be about the same. We can see this is about $35 to about $20. So that's about $15. The stock, like, obviously you can see it right here. Like, the stock probably is not going to go to $5, which would be 30 minus 25, which is 15, and then you do 20 minus 15 is 5. So I guess you have to be a little bit more conservative with this trade just because of the little, it just doesn't make sense to have it go down to $5. But basically, what you can do is you can short it here, you get the heck out of it, and then it breaks below the 200 moving average, and then it just goes down, 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 and then you're kind of golden. You're pretty much set once it does that because it's a pretty solid setup. So I got in at 21.58, so I guess that was, and then went up a bunch, and I was like, holy crap! I almost doubled my investment. This is awesome. And I made the mistake that a lot of people make is, this is kind of a really, really good general rule of thumb. If your investment goes up, say, by 2 or 3 or 4x, there's this cool little trick you can do. And you don't have to always do it. Like if you're investing in something and you like really believe in the company more than almost anything else, and you think without a doubt that it's going to go up in the long term, and there's no chance that it can ever go down, then this might be a little bit different. But for most of your investments and for like a really vast, like huge majority of what you do, you really kind of want to be okay with this idea of taking profits, right? As we take profit, there's this cool little strategy you can use that it works insanely well, that I didn't understand at the time of this trade, but it is now I do it, and it's like, holy crap, it's amazing. And basically what you want to do is, it's sort of like the rule of thirds, some people call it the rule of halves. I tend to look at it as very basic fractions. You have like 1/4, and then you have 1/3, then you have 1/2. And those are kind of the three numbers I like to focus on. And you might be thinking, okay, well, what do these numbers mean? It's actually really simple. Obviously, if you get really great at investing, I have thankfully had the good fortune of doing this, I think, twice in crypto. Yeah, the higher you can get this denominator, the better, and you'll see why in just a minute. But there's also like the super crazy, holy crap, you're a living legend investment, and this one is a little bit more real. We'll get to it in a moment. That's 110, okay? So here's how it works. Basically, you have, whatever stock you buy, and if it doubles, or it comes really close to double, if it doubles, then what you can do is you can sell half. So when your investment goes up by a factor of 2, you can sell half. Okay? Does that make sense? Now, similarly, if your investment goes up by a factor of 3, you triple your investment, then you can sell a third. And what happens when you sell a half, or when you sell a third, is you get all of the money back that you put into the investment, and then you also have a bunch of other stock you can just hold on to, and it's basically like free stock. And so what happens is really cool. Say you own like 1,000 shares of something, and it doubles. Maybe you own 100 shares of a bigger stock, and it doubles, okay? Now you sell half your shares, and you have all the money you put in to buy those shares, and at the same time, you have the original amount of shares that you bought, but they're just yours to keep because the stock doubled, right? And so you only have to sell half. So, like if you own, say, 1,000 shares, and then the stock doubles, and they're worth twice as much, right? Now you can sell this part, you can sell half of them, sell 500, And now you're gonna have 500 shares left, but those 500 shares are gonna be worth what? They're gonna be worth double, so they're worth what your original 1,000 shares were actually worth. And so what happens is really, really, really cool. If you double your money, you can sell half to get all of the investment that you have back, and now everything that you have left is just pure profit. And this is where we get into a really powerful, powerful zone called infinite returns. Because when you invest, or you have $0 in an investment, and however much the stock goes up is, say we bought this at 10, and then we sold half of it at 20, that means that if the stock goes to 30, we're making $10 a share on an investment of $0. And so that's kind of where you get to this really powerful, powerful zone where you can have like infinite returns because you get out of the position after a big amount of growth and you take back your initial investment. So as you might have guessed, if the investment goes up by a factor of 4, that's when you can sell a quarter of the position to get your initial investment back. And what's cool is like after you sell that partial position, you don't have to actually worry about an investment ever again. Now obviously you have a bunch of money invested into it, but it's not like you're gonna like quote unquote lose money. And so like you should really, really try to sell at the top, but you're not gonna be so much worried about like getting $32 a share versus $34 a share because it's like infinite returns. It's like free money, it's pretty cool. As you might have guessed, if your investment goes up by a factor of 10, then you can sell simply 1/10 of it to get back your entire initial investment, and now you can really kind of mess around with the rest of it however you want. And you can totally sell everything you have. Like if you know that the stock's gonna peak at 35 and you're a genius, or you see this green red, I don't know if I have told you guys about this yet, but this is a really powerful candlestick pattern where you have like a really big green candle and then you have a really big red candle right next to each other. This is a huge, huge, huge reversal indicator. Similarly, if you have a really big red candle and then a really big green candle right next to each other, this is a really, really good upward indicator. Really phenomenal. These are really great. Like especially when these are big, like you gotta have big candles. If you have big candles, these work really, really, really well. Especially on 1 month candles. These are 1 month candles, and so when you have 1 month candles and you have like one that's super high green and one that's super high red, you can see the 2 on the top or the 2 that are next to the top. That's a really, really, really good reversal pattern. Anyway, if you see that and you're like, holy crap, this is gonna reverse, or maybe holy crap, this is head and shoulders set up, I should get the heck out. Like there's no harm, no foul in selling everything if you know that it's just gonna tank, because why would you wanna hold this, even if you're only holding it with money that like you didn't have to actually pay for the shares for? Like it wouldn't make sense obviously to hold through the downturn if you know that it's gonna crash and you can buy it back later. And actually you have the same reversal pattern here. You have a big red candle and a big green candle. Exact same thing going on. Obviously if you know what's gonna happen through the magic technical analysis, like you can totally sell. But if you aren't 100% sure, maybe it's a longer term investment, this is a pretty solid rule for taking profits that works really, 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 really well. And so that's kind of the big takeaway here from Wi-Fi. It kind of sucks, like the company, they didn't do that well. I got stopped out, I'm pretty sure, break even, because if the stock was up a whole bunch, I'm not gonna risk any money on it. I probably should have been paying a little more attention to it, and I definitely probably should have taken a little bit of profit when the stock doubled, or almost doubled, but I guess I just didn't really know what was going on with it. The reason I didn't know what was going on with it is because I didn't know that they were actually like losing money. I thought they were making a bunch of money because I was only looking at the revenue, but in reality, their earnings were negative. And so even if you have growing revenues, like if you don't have earnings, you can have situations like this where you have head and shoulders set up and then a massive crash that literally destroys like half of the value or more, 3/4 of the value of the stock in just a couple of a year or so. So definitely a lot to look at. Also, if you look a little bit closer at this and you add maybe Bollinger Bands, you'll kind of see here there's an interior Bollinger Band M setup, which is really, really bearish, and obviously a crossover on the moving average. I was stopped out before then, but just a lot of technical stuff here. But definitely also is kind of cool to see that M setup in the Bollinger Band. It's a little bit skewed on the weekly chart, but it's definitely there. And so definitely like head and shoulder setup, you had M setup inside the Bollinger Band. More recently, this could maybe turn out to be an inverted head and shoulder setup. It actually looks pretty nice. So it might go from like 13 to 9. I say 13 to 10. So that's about $3. So I'd say this is probably about a $16 stock. So I might buy $15 calls on it. besides that, I don't see too much in it. Depends on how expensive they are. They already kind of broke out of that inverted head and shoulder setup. Here you have the first shoulder, here you have the second shoulder, here you have the head. And so what's cool is like you can make money on the upside, or you can make money on the downside, or you can just kind of wait in between. And either way, you're doing pretty well. So these guys probably rebound. I think they might kind of do something like what JD did. I don't think JD's in this portfolio, but they kind of had a similar little setup where basically they went down a whole bunch. It was actually interesting. Like Google gave them like 400 billion, I think they put in like a couple $100 million in like an investment. And after they did, like they went up a bunch for a little bit, but they kind of had the same like same overarching thing where they had like the money coming in, but they weren't like actually making the money, which is okay like in the short term, as long as in the long term you can make profit. Like you just need some kind of reasonable business plan to have income turn into cash. But here I'll add a MACD to make it a little bit easier for you to see this, and we'll kind of shift it over to the monthly chart. But basically you have a very similar setup here, where it's sort of like a head and shoulders setup, and then I thought they were going to bounce off this moving average, but they didn't. And so it just kind of kept on going down. So here you can see they went down a whole bunch. They had this massive crash, kind of like Wi-Fi just had like a really massive crash. And then after that, they kind of bounced back up and have been doing really well lately. So maybe we'll see something like that happen. Definitely is not out of the question. Crossover right here on the MACD is going to be like probably the golden indicator or the gold standard for when to get in on a position like Wi-Fi, because you kind of have two times to get in on this position. The first time is like right at the bounce, if you see a setup like an inverted head and shoulders or a red green candlestick reversal, which on Wi-Fi we kind of have inverted head and shoulders on the weekly chart. So that's kind of your first chance to get in, and it'll usually go up to about the 200 moving average for the weekly or the 50 moving average for the monthly. And then the second chance is usually like a MACD crossover or some kind of stochastics indicator, and those will usually work really well, because you can see like the cross is really strong, and then also the moment that you kind of get into extended stochastics range, if you combine that with that. It's interesting because a bottom in stochastics very often will be a really huge bottom, but a top is usually not like a hard set top, because the stock will just like, and it's kind of interesting, but the stock will just like keep going up and up and up and up and up and up and up. And what it'll do is it'll kind of push up against like the limits that it used to have, and it'll keep on rising through them as it has upward momentum. And you'll see that happen a lot more on the upside than you'll see it happen on the downside. Usually on the downside, stochastic bottom, and you can kind of see right here the stochastic bottom on the monthly, and then it reverses, and that's pretty much that, right? Like it's done. And then you kind of have this upside right here. So a lot of really good setups here on JD, a lot of really good stuff on Wi-Fi. Hopefully Wi-Fi kind of do a similar thing here. Then also you've got a really big red candle and a really big green candle, which again is a phenomenal reversal pattern. And some really great signs to invest. I know you could get like 35 calls super cheap, and those have probably without a doubt sextupled on JD, and that's on like the shorter term trade. If you made the trade starting here, I mean that's a 15, 20, 30x trade. Or if you're just going straight stock, that's a pretty solid 40% or so, which is pretty exciting and pretty dope. So with that said, I really like this company. They do cool stuff, but unfortunately, they did not make a great investment. So that's kind of one of the big takeaways, and one of the important things to remember is just because it's a cool company, just because it's a common brand, doesn't mean that it's going to be a phenomenal investment. And a lot of people, they get in and they're investing in like these big names, and a lot of times they do really well in bull markets, but maybe not so much in bear markets. I have some friends, and they're like buying their first stock, and like calls in Microsoft. I'm like, oh my gosh, that's so cool. But in the back of my head, I'm like, dude, that would never work in a bearish market. And it's cool because we're like sort of at a peak right now. But like the moment that we're not, you're gonna see a lot of people that don't have the right strategies, don't have the right techniques, and don't really know what's going on, and you can get burned pretty hard. I mean, that's a hard crash if you don't understand what's going on. So with that said, you're here, you're learning, you're watching this, and you're actually making it like a legitimate personal effort to understand what's going on, and so that alone is like leaps ahead of everybody else. You're absolutely crushing it, which is pretty exciting and really cool. So with that said, thank you so much. I hope you get a ton of value out of this training. Go out there, apply it, absolutely crush it, and I will see you in the next module. Thanks. Bye.